For today's episode, we'll show you some important accounting basics every small business owner should know and understand. Hi, I'm Bianca Rivera, Accounting Manager from BPS and Outsourcing Division. Join me for an insightful discussion on accounting basics and best practices. Before we get started on the nitty-gritty principles of accounting, let's first define some commonly used and heard phrases. Bookkeepers and accountants, what's the difference? Bookkeepers record financial transactions, while accountants provide an analysis of what those transactions mean. As a business owner, you'd likely be doing a bit of both. As a business owner, remember that financial statements are tools that provide information you need to make short-term and long-term business decisions. Taking time to know more about common accounting terms can make you much more comfortable with understanding the entire accounting process. Double entry accounting means every transaction entered in your accounting system or ledger will affect at least two accounts. For every debit entry you make, you will need to make a corresponding credit entry. This ensures that your account remains balanced. While sole proprietors and freelancers may not need to employ double entry accounting, small and growing businesses will be better served by doing so. Debits and credits are used to record all your small business bookkeeping and accounting transactions. The effect that a debit or credit has will depend on the account type. Let's look at an example. If you post a debit transaction to an asset account, it will increase the balance of that account. But if you post a debit to a liability account, the balance of the account will be decreased. A debit is always on the left side of any accounting transactions, while credit is always on the right side of the transaction. Your chart of accounts is the heart of any accounting system and list of all accounts found in your general ledger, which is where all your accounting entries are recorded. You should create the chart of accounts prior to the recording any financial transactions. Most small business accounting programs include a default chart of accounts that majority can use. Let's get to know some accounting methods you can undertake for your business. Many freelancers and sole proprietors use the cash accounting method, which records cash when it is received and expenses when they are paid, and it does not keep track of the accounts payable and receivable balances. If you have employees or you sell products, you should use the accrual method, which means recording all revenue, income, and expenses as they occur, not when your customer pays or you write a check or a bill. This provides a clearer picture of both income and expenses for a specific period, but it can make it more difficult to manage cash flow properly. What are the items found in your accounts? An asset is anything of value that your business owns. This can include cash in your bank account, your accounts receivable balance, the building you own, inventory, and supplies. Assets can also be intangible such as intellectual property. Liabilities are what your business owes. Your accounts payable balances are considered liabilities because it is what you currently owe to your vendors. Loans are considered as liability as well. Revenue or income is any money received when conducting business. Everything from paying your employees to paying your electric bill is considered an expense. An electric bill to be paid next month, that's recorded as an expense. Equity represents your current financial interest in your business and is derived from subtracting your total liabilities from your total assets. This is an example of an accounts payable. It is a record of bills entered into ledger or accounting software, but have not been paid. Once a vendor has been paid, the AP balance is reduced by that amount. When the electric bill is paid, the following month, the entry would be, here the initial entry in AP is a credit, which increases the balance of that account. Once that bill has been paid, AP and the cash accounts are reduced. Accounts receivable is where all of the funds currently owed to your business are recorded until paid by your customer. Once a customer pays their bill, the AR balance is reduced. You can use AR to acquire insight into your business operations by calculating the accounts receivable turnover ratio. Both AP and AR accounts include aging, which is a way to manage money coming in or going out. AP aging displays a list of bills currently owed, vendors, and suppliers, tracking due dates and advising you when a payment is due or when it is late. AR provides the same information for outstanding customer payments. Once you have multiple customers or vendors, aging reports can become invaluable to your business. While your accounting software would likely handle the majority of the entries needed for your business, a journal entry will still come in handy. This can happen when you see that you need to reconcile your bank account at the end of the month, or it can be for depreciation entries if you're recording depreciation for big-ticket items such as building purchases, expensive computer systems, or the purchase of a company vehicle. While accounting may appear to be intimidating to business owners, just about anyone can easily understand bookkeeping basics. Familiarizing yourself with common accounting terms can make you more comfortable with the entire accounting process. That's it for today's vlog. Join us again next time as we explore and learn more about accounting basics and best practices. Don't forget to like and follow PNE Grant Thornton's social media channels for updates on our next episode as well as our upcoming events.